Welcome to Billionize, your go-to channel for all things finance and investing. Are you looking for ways to earn income in 2023? Look no further than dividend ETFs. In this video, we'll be discussing the top 5 monthly dividend ETFs with high dividend yields. An ETF, or exchange-traded fund, is a type of investment fund that holds a basket of assets, such as stocks, bonds, or commodities. ETFs are traded on stock exchanges, just like individual stocks, which means that the price of an ETF can fluctuate throughout the day based on supply and demand. A dividend is a payment made by a company to its shareholders, typically on a quarterly basis, out of its profits. Dividends can provide a steady stream of income for investors and can also be a sign of a financially healthy company. Investing in ETFs that pay dividends can be a useful way to earn income from your investment portfolio. By owning a diversified basket of stocks through an ETF, you can potentially earn a higher dividend income than you would from owning just a few individual stocks. Additionally, since ETFs are traded on an exchange, they can be easily bought and sold, offering more flexibility than traditional investments such as mutual funds. First on the list is the SPDR S&P Dividend ETF, SDY. This ETF offers a monthly dividend yield of 2.5% and tracks the performance of the S&P High Yield Dividend Aristocrats Index. Next up is the iShares Select Dividend ETF, DVY. This ETF offers a monthly dividend yield of 2.3% and tracks the performance of the Dow Jones US Select Dividend Index. The ProShares S&P 500 Dividend Aristocrats ETF, NOBL, offers a monthly dividend yield of 1.9% and tracks the performance of the S&P 500 Dividend Aristocrats Index. The Vanguard High Dividend Yield ETF, VYM, offers a monthly dividend yield of 2.1% and tracks the performance of the FTSE High Dividend Yield Index. And finally, the SPDR Portfolio S&P 500 High Dividend ETF, SPYD, offers a monthly dividend yield of 3.1% and tracks the performance of the S&P 500 High Dividend Index. Exchange-traded funds, ETFs, are a type of investment vehicle that allows investors to gain exposure to a diversified portfolio of assets, such as stocks, bonds, commodities, and real estate, in a single trade. Each ETF holds a basket of underlying assets and is traded on an exchange, similar to a stock. One of the advantages of ETFs is that they offer a reliable source of income, as many ETFs pay dividends to their shareholders. Dividends are payments made by companies to shareholders, usually on a quarterly basis, out of their profits. By investing in an ETF that holds dividend-paying stocks, an investor can receive regular income without having to purchase individual stocks and monitor them closely. Additionally, ETFs also have the potential for capital appreciation, which is the increase in value of an investment over time. As the underlying assets in an ETF appreciate in value, the value of the ETF also increases, leading to capital gains for the investor. It is important to note that ETFs come in different varieties and can be designed to track different types of assets, sectors, and regions. Therefore, it is important to do your research and consult a financial advisor before making any investment decisions. They can help you identify the ETFs that align with your investment goals and risk tolerance, and also help with the diversification of portfolio. When it comes to investing in dividend ETFs, there are a few key strategies you can use to maximize your returns and minimize your risk. First, diversification is key. Instead of putting all your money into one ETF or one sector of the market, spread your investments across multiple ETFs that track different sectors or indexes. This will help to spread your risk across different assets and reduce the impact of any one ETF underperforming. Next, pay attention to the yield. The yield is the annual dividend payment as a percentage of the ETF's current price. A higher yield may seem more attractive, but it's important to look at the underlying companies and their ability to continue paying dividends in the future. It's also important to consider the expense ratio of the ETF. This is the annual fee that the ETF charges to cover its expenses. A lower expense ratio means more of your money is going towards investments and less is being used to cover fees. Additionally, it's important to pay attention to the market conditions. If market conditions aren't favorable, such as an economic downturn, it may be a good idea to hold off on investing in dividend ETFs. When investing in dividend ETFs, it's important to have a long-term perspective. Dividends are a great source of income, but they shouldn't be your only focus. Dividends can fluctuate over time, and a high dividend yield today doesn't necessarily mean that it will continue to be high in the future. Additionally, companies can also cut or suspend their dividends at any time, which can lead to a drop in the value of the ETF. Therefore, it's important to have a balanced portfolio and to consider the overall performance of the ETF, not just its dividend yield. Another important strategy to consider when investing in dividend ETFs is diversification. Diversification is the practice of spreading your investments across different asset classes and sectors to minimize risk. By diversifying your portfolio, you can reduce the impact of any potential losses in one particular sector or asset class. This is why it's important to invest in a diverse range of dividend ETFs that track different sectors, regions, and asset classes, rather than putting all your money into one ETF. Lastly, it's important to regularly monitor and rebalance your portfolio. A portfolio that is well diversified today may become unbalanced over time due to changes in the market. Therefore, it's important to regularly review your portfolio and make adjustments as needed to ensure that it remains well diversified and aligned with your investment goals and risk tolerance. In conclusion, investing in dividend ETFs can be a great way to generate a reliable source of income, while also having the potential for capital appreciation. But it's important to have a long-term perspective, have a balanced portfolio, diversify your investments, and regularly monitor and rebalance your portfolio. Consult a financial advisor and always do your research before making any investment decisions.